Investing in stocks is just another form of gambling. If you have ever come across this statement, you are not alone. Lots of people hesitate to invest because of widespread myths that have been ingrained in society. Unfortunately, these misconceptions prevent individuals from taking advantage of the wealth-building potential the stock market offers. But what if most of what you've heard about investing is actually misleading? This video will debunk the most common myths about stock investing and reveal the facts you need to make informed financial decisions. Whether you're a beginner or someone hesitant to get started, understanding the truth will empower you to navigate the world of investing with confidence. Myth #1. Investing in stocks is like gambling. Many people believe that investing is simply rolling the dice in a casino. However, the key difference is that investing relies on strategy, research, and long-term planning, whereas gambling depends purely on chance. Investors analyze financial reports, market trends, and company performance before making decisions. Stocks represent ownership in a business, meaning that their value is driven by real-world earnings and growth. Long-term investors who diversify their portfolio are less exposed to risk compared to gamblers relying on luck. Unlike gambling, where the house always has an edge, investors have the opportunity to make informed choices that increase their chances of success. Historical data shows that over time, the stock market has delivered steady growth, rewarding those who invest wisely and remain patient. While gambling results in an immediate win or loss, investing allows for risk management through asset allocation, portfolio diversification, and strategic decision-making. Gambling is about hoping for a quick win. Investing is about building wealth over time through discipline and informed choices. Myth #2. You need a lot of money to start investing. Another widespread myth is that stock investing is exclusive to the wealthy. The reality, you can begin with as little as $10. Many platforms offer fractional shares, allowing you to buy a piece of expensive stocks like Amazon or Tesla with minimal funds. Commission-free trading apps make it easier than ever to start small and grow your portfolio over time. A consistent approach, such as investing a small amount every month, can lead to significant wealth over the years. Don't let a limited budget keep you from getting started. The key is consistency, not a massive initial investment. Myth #3. The stock market is too risky for the average person. Yes, investing carries risks, but so does leaving your money in a savings account that hardly keeps up with inflation. The stock market has historically delivered higher long-term returns than any other asset class. While cash sitting in a bank loses purchasing power over time, stocks grow in value, outpacing inflation. Diversification helps spread risk across multiple stocks and sectors, reducing overall exposure to any single company's downturn. Investing in exchange-traded funds, ETFs, and index funds allows you to own a broad selection of stocks, minimizing risk compared to betting on individual companies. Long-term investing strategies help smooth out short-term volatility and maximize potential gains. Market downturns are temporary, and historically the stock market has always rebounded, rewarding those who remain patient. With the right strategy, investing can actually be less risky than not investing at all. Keeping your money in a low-interest savings account may feel safe, but it guarantees a loss in purchasing power due to inflation. By taking a calculated approach to investing, you can protect and grow your wealth over time. Myth #4. You must be an expert to make money in stocks. The belief that only financial professionals thrive in the stock market is untrue. Anyone can grasp the basics and begin investing with simple strategies. Index funds and ETFs allow you to invest in the broader market without picking individual stocks. Robo-advisors help automate investments based on your financial goals. Plenty of free educational resources and investing tools make it easier than ever to get started. Many brokerage platforms provide beginner-friendly features such as paper trading and guided investment options. With long-term disciplined investing, even those with minimal experience can achieve financial growth. You don't need a finance degree, just patience and a willingness to learn. Myth #5. Stocks that go up always keep rising. A common mistake among new investors is believing that a stock's strong performance will persist indefinitely. However, past performance does not ensure future results. Market conditions change and companies face competition and economic downturns. Even great companies experience periods of decline before rebounding. Economic shifts, regulatory changes, and global events can impact stock prices unpredictably. Smart investors don't chase past winners blindly. They assess fundamentals, industry trends, and valuation metrics before making decisions. The key is to diversify and avoid putting all your money into one hot stock. Instead of assuming a stock's upward trajectory will continue, focus on long-term stability and sound investment strategies. Myth #6. Timing the market is the key to success. Some think the best investors are those who perfectly time buying low and selling high. In reality, mastering market timing is nearly impossible, even for professionals. The stock market is unpredictable. Even experienced traders often fail to time their trades perfectly. Dollar cost averaging, DCA, investing a fixed amount regularly, reduces the risk of buying at the wrong time by smoothing out price fluctuations. Emotional investing based on short-term trends often leads to panic selling and poor decision-making. Long-term studies show that staying invested consistently leads to better returns than attempting to jump in and out of the market. Even missing just a few of the market's best-performing days can significantly reduce your overall returns. Instead of trying to predict the market, focus on long-term, consistent investing and let compounding work in your favor. Myth #7. Dividend stocks are always safe investments. Some investors assume that dividend-paying stocks are always a safer choice, but that isn't necessarily true. While dividends can provide a steady income, some dividend stocks carry higher risks than others, and factors like company stability and payout sustainability should be considered. Some companies offer high dividend yields to attract investors but may struggle financially. A high dividend yield can sometimes indicate a company in distress rather than a solid investment. If a company faces declining profits or economic downturns, it may cut or eliminate dividends, affecting investor returns. Some dividend stocks lack significant growth potential, meaning investors could miss out on higher returns from growth stocks. A strong dividend stock should have a history of stable earnings, reasonable payout ratios, and consistent growth. While dividends can be a great source of passive income, relying solely on them without analyzing the company's overall financial health can be risky. A balanced approach that includes both growth and dividend stocks can provide better stability and long-term wealth accumulation. Conclusion: the road to wise investing. The stock market is not a casino, and success doesn't require being a financial expert. By recognizing and dispelling these common myths, you can invest wisely and make informed choices with confidence. The secret to successful investing lies in 3 essential principles. Start as early as possible to maximize long-term growth. Stay consistent with your investments regardless of market fluctuations, and continuously expand your knowledge to make informed decisions. Ready to take control of your financial future? Subscribe to our channel for expert investing insights and strategies to help you build wealth wisely.